Good morning, everybody. It's January 8th, Monday, January 8th. We're doing this live. For those of you who like to tune in but sometimes can't, there's a replay that's always available. The link is on the notice for the call on Mondays. I'm Ed Yardeni, and of course, there's Max in his usual position. So everything is copacetic, as they say. And so let's start off by talking about the weather. I don't know why I do that, but it makes a good segue to our discussion, depending on what the weather is. Right now, the week looks pretty good, right? We've got a very sunny day here in Long Island, as you can see by the background there. I do have some shades there, but it's so sunny it just goes right through. But tomorrow we're expecting a deluge. So the weather is going to continue to be as nice. We didn't get any snow over the weekend. On Sunday, there was supposed to be a lot of snow, but it went up north of us. So we cleared that. We got mixed weather, and the market's been kind of mixed. We've seen some pullback with the mega cap 8 stocks. We've seen, last week was not a great week for mega cap 8 or the market generally speaking. But all in all, it's still a bull market, in my opinion. I think it's overdue to stall for a little while here. Why might it stall? Well, I think investors are kind of confused here in terms of what we're supposed to be rooting for. And I wrote a quick takes that I sent you last night. And the question is, if we get really good economic indicators, the stock market may not actually like that. Certainly, the bond market wouldn't like it because it's all about the Fed, right? The idea is that the Fed is basically declared that they are done raising rates, that they are in sufficiently restrictive territory, that they don't have to raise rates anymore. And of course, if they just keep rates here and inflation continues to come down, some of them would argue, including Fed Chair Jerome Powell, that inflation comes down and they keep interest rates at the current levels, that would actually be more restrictive because real interest rates would be going up. But the markets had a great festival, Santa Claus rally that really started on October 27th. It started way ahead of schedule. But we had a lot of festivities on the notion that the Fed is done raising nominal interest rates. And now the markets have been discounting that it will be lowering nominal interest rates as inflation continues to moderate. But if we get strong economic indicators, then maybe the Fed isn't going to be all that much in a rush to lower interest rates. So maybe the market has over discounted that. We're in the 2 to 3 rate cut camp. The market's been in the 4 to 5 rate cut camp. We're in the same camp as the summary of economic projections that came out in December of last year that was put out by the FOMC. I found it very helpful here to go along with what the Fed's says they're going to do. It's actually worked pretty well for the past 2 years. Many Fed watchers tend to be contrarians when it comes to the Fed and say, well, these clowns could never be right. They couldn't possibly be right again. Inflation is going to turn out to be a lot more persistent. The economy is going to go into recession and so on and so forth. And yet, when you looked at the summary of economic projections, they actually agreed with what Powell's been saying, that there is he's been saying basically there's a small chance that there is a narrow path to victory here in terms of victory being inflation coming down without a recession. And that seems to be what's playing out. That certainly has been what's played out for the past 2 years. So when the employment numbers came out on Friday, investors are a bit confused. And the top line looked better than expected. But when you drill down a little bit, it wasn't quite as strong. Government accounted for 50,000 jobs, though those are real jobs. And those people are employed and then they go out and spend money. So I don't know why there's this tendency to, I guess it's the old story that I and other economists use. We always take out what doesn't support our story, and then see we're right after all. Um, so I kind of like the top line number. It supports my story, so I'm kind of leading in that direction. Wages rose 0.4 instead of 0.3% month over month, and that gave us some agita to some people maybe in the bond market, or those thinking, well, maybe price inflation's come down, but wage inflation is being sticky. But look, Powell said that wage inflation really isn't the key to their thinking about inflation. They really are focusing on price inflation. And he said that he could, that the Fed could certainly tolerate wage inflation of 3 to 4%. And most of the numbers are just above 4% for wage inflation. We got different measures of wage inflation. So the other thing that's important to recognize is that even if you strip away whatever was strong and leave whatever was weak and say that's what the labor market's really doing, then the conclusion has to be that well, it's a good thing wages went up more than prices, and that means real wages are going up so the consumers can spend. Now, look, real wages were stalled out last year. They, take average hourly earnings divided by the consumption deflator, and they went absolutely sideways. So there was a lot of stagnation in real wages. Fortunately, there was a lot of growth in employment, and there's still some excess savings left. Excess savings that Jamie Dimon has said is we're going to run out of any minute, and consumers going to retrench. We don't agree with that, but that's still a possible valid scenario. But the consumer is still in good shape from that perspective. So when I look at the employment number, I think it was all right. Then there was good reason to get a little bit jittery about the non-manufacturing PMI. The non-manufacturing PMI was weaker than expected. It was still a little bit above 50, but I think it was down a couple of points. But it was led by a unbelievable drop in the employment component of the NMPMI. And I emphasize unbelievable. It's really hard to believe because it's the kind of drop you get in recessions. Uh, and yet we saw that services employment in December, the very same month that we saw a plunge in the employment indicator for the national index for non-manufacturing purchasing managers, that very same month, service employment was up 142,000. So go figure. And what I figure is the number doesn't support my story, so I don't really believe it. But if you're in the hard landing camp, say notch that up for you because it's certainly supportive that the service economy, for some reason, is suddenly imploding. The actual employment data showed the services were strong in the usual places. Hospitality and accommodations and hospitality remain strong. Healthcare remains very, very strong. And that's kind of what you would expect when consumers have been continuing to pivot towards services. So put it all together, and I think we got an economy. Oh, visiting us here. That's Bailey. So put it all together, I think the economy is doing fine. I think price inflation is going to continue to moderate. Today, we've got the price of oil falling by another $3. Maybe that's all we really need to know. Since September 27th, the price of oil has dropped dramatically, even in the face of all this geopolitical turmoil. So that's telling you that the global economy is very weak. The U.S. economy is doing okay, but China's economy may be a lot weaker than people realize. And Europe's economy, we just got their composite flash indicators. Those look quite weak. So there's a possibility here that Europe is actually in a recession. They had a negative third quarter, and now they could have a negative fourth quarter. So there's enough weakness in the global economy, as evidenced by the drop in the price of oil. I'm watching the price of copper, and that's not doing much. You would think with housing activity likely to make a big comeback in the United States, the price of copper might actually bounce back over the past few weeks, and the perception that lower mortgage rates will revive housing activity. And indeed, housing starts have firmed up, and yet the price of copper is doing not much of anything, just still about $3.80. And so that suggests whatever strength we got coming out of the U.S. is being offset by ongoing concerns about what demand for copper related to the property market there. For developers certainly aren't going to be developing properties for a while. Look, the property market in China really was the biggest engine of growth in the global economy for many years. Um, I think it's clear now that the engine is sputtering, but it's pretty clear that because it's sputtering, that's affecting China's overall economy. With regards to Taiwan, I don't know whether that means that they're going to invade Taiwan tomorrow or they're going to postpone until the economy gets better. Um, there's two ways to argue that, of course, but that's not the point of our discussion today. The point of our discussion today is to review some of the charts that we put together for for the morning briefing, and that's to discuss the question of leads and lags. I just want to make sure I'm not get anybody telling me that I got. Okay. Um, so, as you know, a lot of people have been in the die-hard hard landing camp have been saying, okay, we didn't get the recession in 2022. We didn't get it in 2023. We're going to get it in 2024. And how do they know that? Because there's long and variable lags between monetary policy and the economy. That was a concept invented by Milton Friedman, but I don't know that he or anybody else has ever actually sat down and said, well, what does that really mean? Why are there long and variable lags? And, what are the causes of them? And are there really long and variable lags? I mean, let's take the current situation. It's relevant. It's certainly top of mind to all of us. When we saw mortgage rates soaring early in 2022, they soared not just because the 10-year was going up, but the spread between the mortgage yield and the treasury widened dramatically. After all, the Fed kind of in its January FOMC minutes that actually they were released on January 5th of 2022 for December. And in there were a couple of statements that basically suggested that there were some Fed officials that really wanted to get out of the mortgage lending business. They wanted to get out of their mortgage-backed securities. And so when the market saw that, mortgage rates absolutely soared. And that really immediately, there's no long and variable lags there. That immediately put the kibosh on housing activity, particularly single family housing. Multifamily remained strong because of the underlying demand because rents were high, but single family certainly got hit pretty quickly. Now mortgage rates are down about 100 basis points from I don't know, well they're down to like high 6%, and they're down by 100 basis points. And you would think that there could be a pretty quick response in the housing market, and so there seems to be. The housing starts activity seems to have picked up, and I won't be surprised if existing home sales will start to pick up. And that in turn implies that the goods recession we've been in, some of that related to people not buying houses and not buying housing related durable goods, well, that may soon reverse and go from what I've been calling a rolling recession in the goods market to a rolling recovery in the goods market. There's certainly indicators that suggest that the goods recession is bottoming. We're seeing that in the ISM manufacturing PMI. It's still below 50, but it's not going lower, and it's kind of seems to be going sideways for a while. But that could start to pick up as the year progresses. So when you look at these various variables on the housing side, it looks like they can come back pretty quickly, and the same thing can be said about durable goods. Autos really haven't gotten whacked. I mean, it's mind-boggling to see that light trucks now account for something like 80% of auto sales in the United States, retail auto sales. That's extraordinary because, as we all know, these are very expensive toys to have. They come up outfitted with all sorts of bells and whistles and electronics, but they are expensive. And even though the bank loan data shows that auto loans are actually down on a year-over-year basis, I don't know where people are getting the money, but auto sales are still kind of hanging in there. Around 5.8 million units was what we saw the seasonally adjusted annual rate in the latest data. Well, how about commercial real estate? Isn't that going to take a while to really implode? Well, it seems like most of the data is suggesting that the problems are with old office buildings in downtown areas, whereas other areas of commercial real estate are still doing just fine. And meanwhile, when you look at construction employment, it's at an all-time record high, both for construction of homes, multifamily, single family, as well as non-residential construction. We know that, for example, the construction of manufacturing facilities has been absolutely booming. We know that onshoring is contributing to a great demand for construction workers. So in the past, higher interest rates would depress the construction market, would depress construction employment, and that would be a contributor to what might have been sort of a longer and more variable lag. But this time, that's simply not the case. Well, where else could the lag possibly be? Again, the consumer looks okay. Capital spending, maybe we're going to see some cutbacks there, but again, the offshoring and the manufacturing boom is construction boom is an offset to that. And meanwhile, usually in the past, when we've had recessions, actually been in a recession, it took a while, but fiscal policy finally stimulated things. So, but we did get out of the recession with fiscal stimulus and with the Fed easing, but all in all, the economy didn't really have a long and variable lag. The other possibility is that the first thing that happens when the Fed tightens is you get a cutback in demand, and that at some point that hits manufacturers get and retailers get what's going on, and they start to cut back their hiring. So perhaps we know that the unemployment rate tends to be more of a coincident and a lagging indicator than a leading indicator. So maybe the trick to understanding the long and variable lag is that it takes a while for unemployment to really get high enough to really depress the economy. Well, let's look at some charts that are relevant to our discussion here. I mean, and I saved the our basic conclusion for an intro here. Okay, so here's what I'm thinking. What I'm thinking is that it's credit crunches that cause recessions. We've talked about this before. Melissa Tagg and I wrote a book back in 2019. It was actually a small study. I don't want to exaggerate the magnitude of this thing, though. I think the conclusion has turned out to be fairly relevant to the current environment and has helped us thinking about the economy. But what we concluded is that inverted yield curves don't predict recessions. They predict the process that leads to a recession. What they predict is if the Fed continues to raise interest rates, something will break in the financial system, and that will turn into a credit crunch, and that in turn will is what causes recessions. So the inverted yield curve worked out like a charm this time, right? We did have a financial crisis. That's what they predict: financial crises. Then the financial crisis becomes a credit crunch and a recession. So they did predict a financial crisis. There was a financial crisis last March. Three banks went under, but the Fed came in so quickly. You know, the Fed's used to playing whack-a-mole with these crises, and so it immediately came up with a liquidity facility on March 12th that stabilized the situation. So we didn't get a credit crunch following the financial crisis, and as a result of that, we haven't had a recession. So it's credit crunches that cause recessions, and in my opinion, and that's what I would kind of raise my alarm bells or cause me to ring the alarm bells if I saw a credit crunch, widespread one, then I'd become concerned. Here, what you're seeing in these charts is this is the federal funds rate and the financial crises, and we've identified a few of the key financial crises. And guess what? The Fed typically starts to lower interest rates when a financial crisis hits, because that becomes a credit crunch, that becomes a recession, that brings inflation down. This time around, as you can see, we haven't had the credit crunch, we haven't had the recession, but the Fed has concluded that that's allowed the Fed to get to a level of the Fed funds rate that seems to be doing the job. By the way, I don't want to give the Fed full credit here for bringing inflation down. The reality is a lot of this turned out to be a transitory inflation spike, largely related to the pandemic. Here's the yield curve spread, and again, financial crises. And you can see a pattern there that the yield yield curve tends to invert, anticipating a financial crisis. The financial crisis hits, and then the yield curve starts to disinvert as short-term rates drop faster than long-term rates, as the Fed realizes that things are falling apart in the credit system. And at the end of the day, they've got full responsibility for the banking system and the credit markets, and so they lower interest rates dramatically, and the bond market starts to figure out that it's good that we bought the bonds before the financial crisis, and then when the financial crisis hits, they're still bond buying, but less aggressively than the Fed is lowering interest rates. So this shows the nature of the current financial crisis that we had last year, and you can see we're not exactly out of it. The bank term funding program is still high, but it's pocket change. In our huge economy, $133 billion is not a huge amount, and some of that reflects banks going out of the discount window borrowing and maybe going into borrowing in this area. So it's not like we're back to zero and there's no signs of a financial crisis whatsoever, but it's contained, very well contained, and it's very small. So we actually have a situation now where the Fed got to a restrictive level, didn't cause a credit crunch, didn't cause a recession, and yet the bond and mortgage markets are anticipating that the next move by the Fed will be to lower interest rates, either because inflation continues to come down and the economy grows, or for those who believe a recession's coming, inflation's coming down, and you want to be even more aggressive in the bond market. Uh, we're in the camp thinking 3.75% to 4.25% is probably about as good as you're going to get in the bond market for a while, because we don't have a recession. We do think inflation is coming down, and we think it's coming down ahead of schedule, probably hit 2% before the end of the year. And of course, this drop in oil prices every month that the price of oil drops, that's another month that we have deflationary pressures in the CPI and the PCED coming from energy. And energy is a very important, influential commodity when it comes to overall inflation. So here's a story on that consumer durables. These gray shades are, this is the peak in the Fed funds rate. This is the bottom in the Fed, I'm sorry, this is the bottom in the Fed funds rate, and this is the peak in the Fed funds rate. I knew I should put in a footnote, and I'll put a footnote in next time, because if I'm confused, I guess other people might get confused. But this shows when the Fed's been raising rates, and then, of course, this is when they're lowering rates. And here they've been raising rates, and we did actually have a goods recession in durable goods in late 2020 and 2021. Everybody just went on a buying binge, buying durable goods. They couldn't buy anything else coming out of the pandemic. And so we actually had a negative comparison for durable goods, but now it's actually climbing up. How do you get a recession when that's happening? And especially now if you get housing making a comeback and housing-related durable goods. This is the housing-related durable goods. You see they were in a recession. This is in current dollars. It's probably weaker in real dollars. This is the stock market. Stock market has the prices have been buying opportunities in the stock market in the past. The market, like the bond market, the stock market, like the bond market, anticipates that if the Fed keeps raising rates, something will break, and something breaks, and then the Fed lowers rates. We get the disinversion of the yield curve. The recession turns into recovery, and the stock market figures all that out. It did that here. These were different scenarios. This is where things got a lot nastier. Actually, these are those scenarios where the stock market and the credit system really contributed greatly to the recessions here. And so these were different, but this situation, the current situation, looks a little bit similar to what we've had here, where the market kind of bottoms out. When the crisis hit. And March was the crisis, but it actually bottomed out on October 7th of 2022. 2020. Oh, well, you'll tell me. Can't do this all by myself. So to remind me whether it was 2022 or 2020. No, it was 2022. It was the bear market lasted from 2022 to to October of that year. Okay, I'm on the record back straight. Okay, here's the 10-year Treasury bond yield and financial crisis. same story. Good time to buy the bonds is when the crisis hits, which is what the inverted yield curve anticipate. Um, this is the overall. Oh, so now with regards to leading and lagging indicators, isn't there supposed to be a wealth effect on the consumer so that when their wealth is going down, they're depressed and they cut back spending, and their wealth is going up, and they're feeling pretty good about things. So if there's long and variable lags out there in the system, isn't there going to be a positive wealth effect from the stock market going up, from some relief on the annihilation in the bond market, some decent capital gains since October? Isn't that going to be offset the some of the negative effects of the long and variable lags, if they really exist? Again, I think a lot of it has to do with credit crunches. Um, Another reason to not be concerned that much about capital spending is I think it's become less interest rate sensitive. I think it's a lot of it. 50% of current dollar capital spending now is goes into spending on high tech, and a lot of companies are spending on high tech no matter what. They have to spend on high tech in order to deal with the labor shortages and to increase their productivity and efficiency. And it's also a competitive thing. Everybody's got access to the same technologies that can really improve productivity. If you don't use it, your competitors use it, you'll go out of business. Well, how about the long and variable lags in loans? This is C&I loans. It's turned negative here, so maybe it takes a while for C&I loans for the banks to cut back. But C&I loans are highly correlated, not surprisingly, with let me just yeah, not surprisingly with inventories, and you can see inventories, uh, manufacturing and trade inventories have been going sideways in current dollars. That's what loans finance current dollar inventories. So that has really more to do with the goods recession. I've been saying since early last year that we are. I keep missing the years. I've been saying since early 2022. I should have a little calendar in front of me here, a timeline. So I've been saying since early 2022 that we're in a recession. It's just a rolling recession, and we've been in a rolling recession in goods, and yet the overall economy has been doing just fine. Here was some. You can look at it on your own. There's some weekly data we look at on various loan categories. Maybe the commercial real estate is something to start worrying about, but it's big, but it's not big enough to take the economy down if we got lots of other areas of strength in the economy, which we do. So how about the unemployment rate? You get the Fed tightens. It takes a while for demand to come down. Then it takes a while for workers to be fired. Then when they're fired, that worsens the recession or causes the recession, I guess is the argument. But the idea is that interest rates work through demand. And my idea is that interest rates work through crunches. And if you don't get a crunch, you don't get a recession. Um, so there's evidence in the data that came out on Friday, the employment numbers. We immediately go and calculate the earned income proxy, which which is highly correlated, as you can see in nominal terms, with wages and salaries and personal income. It actually rose to a new high, and it rose by enough, I think, to offset what inflation is going to what did in December. And so real wages, I think, are still going up, which drives consumer spending. This you can look at on your own. Well, we did it. Okay, we did it, but I did leave a lot of room for a little discussion. But let me try to do that now. Me put on these glasses so I can see a bit better. And see, I just want to see. Okay. Okay. And as usual, Chloe's here, and we got to let her. Sorry about that. Otherwise, she's been growling all the time. All right, let me just take a couple of questions because I did overstay my welcome here. Gus, and the members of the Fed continue to comment that they are focusing on wages as the main driver in their decision making to cut rates. Well, maybe some of them are, but you know the the chair, Fed Chair Jerome Powell, has been pretty consistent in his story that he's not that concerned about wage inflation. He wants to see it come down, but he said, look. he basically implied if we get 1 to 2% productivity, which isn't impossible. 1% certainly is impossible. 2% maybe a little bit harder, but the past couple of quarters we've been getting that. I don't know. I don't think that they are as concerned. I mean, don't forget they're going to come up with any excuse to explain why they're remaining restrictive when inflation's coming down, because they don't want to. They don't want to. For them, the nightmare would be inflation making a comeback, price inflation. So they want to be careful about that. Um, okay, we talked about the productivity. Cagdus, how are you thinking about the impact of U.S. elections on the stock market on a high level this year? When do you expect that impact to kick in? Your Denny vest looked good last week. Thanks. As looking into a whole new business, a clothing line with the Yardeni logo, Yardeni Research logo. Look, I, my work tends to be nonpartisan. I have my views, but to me, what we have to do in this business is keep our politics at home. Well, I'm working at home, so maybe that's not a good idea. But uh, keep your politics out of your investment portfolio. But certainly, you have to have some opinions about how the political landscape might affect the stock market. That's and the bond market. And I just keep coming back to the notion that look how well the stock market has done, look how well the economy has done, despite Washington. That tends to be my kind of go-to simple way of looking at things when it comes to the markets. So I I'm not sure that the markets are going to really pay much attention. I mean, we know that there's a lot of partisanship. We know that people don't talk to each other on both sides of the aisles. Yet it looks like the new Speaker of the House is actually might be making some progress in working out a deal with the other side. That would be sort of a grand compromise, believe it or not, on spending as well as on Ukraine, Israel, and border. So wouldn't that be nice? But maybe that's wishful thinking. But one of our Washington sources that I respect seems to think there's something afoot here, that there is some actual progress. Though the thing that could kill it again is the ultra conservatives and the Republican Party. We have partisanship not just between Democrats and Republicans, but also within each of the parties. Kevin, in your analysis of the markets, do you worry about or see a path for stagflation creeping in the coming years? Kevin, I hate to be glib about it, but stagflation is so yesterday. It was a very 1970s. I've acknowledged that it could turn out to be the 1970s, but over the past couple of years. But I've also said that it looks more and more like the Roaring Twenties than the 1970s. So I'm not seeing stagflation as a real issue. I'll take one more. Ian, what's your take on the Fed slowing QT once the rate reductions begin, especially to stabilize cash reserves in the banks and overnight repos? Yeah, I wouldn't be surprised if they terminate QT before they start lowering interest rates, and that could certainly get the markets roaring again in anticipation that the next thing they do is in fact cut interest rates. So that could be a very important event. Well, I hope we have lots of important bullish events up ahead here. Chloe just came back in. Sorry for the interruption, but you know, your pets don't. My pets don't come first, but I do try to make them happier. I don't know if any of them. I got to go find the other ones because the other ones probably are running around the block now, and I'm going to have to take my car and look for them. That sometimes happen. I hope it's not happening now. Anyways, wish me luck. I wish you luck, and let's do this again next week. All the best.